Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me are Sumera Abdi and Pavitra Pari. Good morning, girls. After a gap down start, things have started picking up for our market. So we're recovering from the day's low. So the Nifty is currently up 70 points from the day's low. It's just marginally in the red, down close to about 14 points. Mid-caps are sulking a bit. Again, there has been a recovery on the mid-cap end as well from the day's low, but it's still down close to about 220 points. That's down 0.7% on the mid-cap index, and the advanced decline ratio is still in favor of the losing side. It's the PSU banks. They had a fantastic run in the early part of this week, so there is some profit booking visible. Nifty PSU banking index is down close to about 1.5%, and on the gaining side, IT is up close to about 0.6% today, and Nifty FMCG. There's so many FMCG companies reporting numbers. Today you've got ITC, HUL, HUL, ITC, Asian Paints all come out with numbers today as well as tomorrow. So in the span of 2 days, and Tata Consumer as well, not to forget. So 4 of those large FMCG companies will be reporting numbers. So ahead of that, the Nifty FMCG index is showing you a gain of close to about 0.5%, and for the week as well, it's up close to about 2%.
Hi, good morning. So yeah, we're definitely moving towards the flat line. You're actually seeing that recovery play out in the rest of the Asian markets as well. So you'll see Hang Seng, Taiwan, some of these markets are also moving higher right now. In addition to FMCG, some of the tech companies are holding up. So those ones will be up on your screen. Reliance is another one ahead of its results tomorrow. It's doing well. By the way, for this week, Reliance is up around 6%. So that stock has definitely done well. Reema's already mentioned the PSU banks, which are seeing some cuts. So in addition to the larger ones, you also have some of the smaller banks which are under pressure today. So Indian Bank, Bank of Baroda, just a few I'm naming, but across the board, you're seeing a little bit of pressure there. Loss for us to track in terms of Qs, because we did see a big rally in crude prices overnight. So we're watching what's going on over there. And of course, the dollar-rupee move is extremely crucial to watch. Like Reema was pointing out, there are a lot of earnings coming through today as well as tomorrow. So let's just put a few of those up on your screen. You have a lot of the FMCG names, but you also have Axis Bank, Bajaj Finance, which will post earnings today, and tomorrow of course you have Reliance, which will come out with its earnings. So Sumera, lots really for us to track.
All right, so let's get started right away then. Here's everything that we have lined up for you over the next 1 hour. Nifty and Sensex pair some losses after a subdued start following a weak global handover. To talk about the market and the sector specific points, we'll be joined by Prateek Parekh of Nuvama Group.
The rupee hits a fresh record low against the US dollar today, slipping to all-time low levels for the second straight day. We have a complete analysis lined up in just a bit.
From the earnings corner, we'll put the spotlight on mid-cap IT companies. We'll be joined by the management of Sonata Software shortly, and in a little bit also Persistent Systems, to talk about the quarter gone by and the way ahead. All this and much more lined up over the next 60 minutes.
All right, let's invite the first corporate on Trading Hour then. We've got the management of Sonata Software joining us. The consolidated revenues have declined by 15.5% on a quarter-on-quarter basis, though margins have improved on a sequential basis to 10.3%, which compares with about 8% on a year ago. What you can see on your screen is the IT services margins, which for Sonata Software have now declined for the 5th consecutive quarter. Sonata Software's revenues come from the IT services business, which is about 30% of their revenues, and the balance 70% comes in from domestic product sales. So that's the breakup of the company's business. We're now joined by the CFO of the company, Jagannathan Chakravarti, on the show now. Good morning, and thanks so much for joining in. So first, focusing on the IT services business, where the dollar revenue growth is about 1.7, 1.8% on a sequential basis, and margins have fallen. As my team was showing, margins have fallen for the 5th straight quarter in a row. Could you give us some guidance on revenue? Because there is a lot of uncertainty about the demand environment and the outlook on margins for the IT services business.
Yeah. Let me take the question on the revenue situation in the IT industry at present. Although there is a lot of news, we are also reading the news, but the ground in feedback or ground order demand position or a pipeline position, it doesn't look like that. It looks pretty strong at present. We are not seeing any change in that, any negative outlook in that at present. So we are confident that this year we will, for the next couple of quarters, next 2 quarters, it will be this revenue momentum will continue to be there. Regarding the profitability outlook, you have highlighted that we have dropped the margin. We have mentioned in the beginning of the year there will be an investment phase also, and the supply chain on the people side hasn't stabilized completely. It has improved a lot compared to Q4. Q1 was better, and Q1 to Q2 was definitely better. The attrition is coming down. However, the entire supply chain issues have not no. There still exists issues in few parts, particularly on the cost of hiring, definitely continue to exist. So this will have to be smoothed over a period of next couple of quarters. That will happen, and that may help us to some extent on the margin trend. Apart from it, if you see the fluctuation in the currency has impacted the cross currency for us, both in the revenue terms as well as in the hedging trend. With our 6 quarters of hedging strategy, which worked for a very, very long time for us in our favor, this quarter, because of the swing, because of the depreciation of the currency, the hedges have gone negative on that. So we need this kind of a strong fluctuation in the currency has actually impacted to some extent on the profitability side also, apart from the revenue side.
Margin guidance for the full year?
We are not giving a guidance on the profitability front, but we have told in the beginning of the year that 20 to 22% of the EBITDA we will achieve. We are very confident we will meet that the top end of that guidance, whatever we have given to the market in the beginning of the year. In spite of all the cost fluctuations or investments, what we do, we are confident that our margins will be much better in the coming quarters also. Means it will not change anything dramatically here. From our guidance, we will be in the top echelon of the guidance, whatever we have mentioned.
Right. Hi, Mr. Chakravarti. Good morning and thanks for joining us. This is Pavitra. So you're saying 20 to 22%. Even if I assume the upper end of that range at 22%, it's still sharply lower than the 26% that you've been doing. So can you tell us why you think that you're going to see such a sharp fall?
I'm not saying it's going to be such a sharp fall in this immediate quarter. What we guided for the whole year was depending on the investments as well as on the salary increases that is due in Q4. But I'm not saying it will be 22%. It will be much better than that 22%. We don't give a forward-looking guideline, but the situation in the first 2 quarters have been better for us. The investments as well as the salary increase may impact Q4. Even considering that, we will be much better than whatever the guidance we have given.
Okay, will it be better than 22? So will it be closer to 26?
I don't want to comment on that because we don't give the guidance for that, but definitely better than what we are situation.
Okay, moving on to the other part of your business, the domestic products. It has seen a sequential fall of around 22%, but if I look at it on a year-over-year basis, there is a rise of around 70% as well. Can you tell us how demand is looking here?
Yeah. We have told multiple times that please don't measure this business with the revenue. This revenue is like a turnover. So you can't measure it exactly on the turnover basis for this business. This has to be measured on absolute amount of gross contribution, what they make and how it is growing quarter on quarter. The absolute contribution of this business have been consistently growing, and this quarter also it has grown compared to what it was in the last quarter. The demand scenario for this business is very strong, and we don't have any doubt about it. The cloud transformation in Indian business has been very steadily growing, and we are very confident of doing well in this business. The absolute contribution has been consistently growing for many quarters now, and this reflects a very strong fundamental demand in this business.
So we should be looking at the EBITDA for the domestic products business?
Yeah, EBITDA is also growing up. The absolute amount of EBITDA is also growing up because the gross contribution as a percentage may be lower. So please don't measure this business on the percentage. This is like how much of absolute gross contribution I make from this business, and automatically the EBITDA and PAT is taken care. So since the investments is not very big in this business, the very key driver for this is how much of absolute gross contribution we make, and that gross contribution absolute amount, how it is growing over a period of time. We have been consistently saying minimum of 15% growth will be there. We will definitely, last 2 years we have done more than 20%, and we are confident of meeting the top performance to continue in this year.
So what was the gross contribution of domestic products in this quarter? What was the number?
Yeah, it's about 57 crores. Last quarter, it was about 55 crores.
57 crore. Okay. And is there a guidance that you can provide us on this?
No, we don't give a guidance again on this because we don't give this for any profit or revenue for the guidance is not being given. But the broad guidelines, what we have always set is like 15% year-on-year growth on the absolute gross contribution amount. And we have been beating that comfortably for the last couple of years.
Okay, just one final question. You have around over 500 crore of cash in your books. Any plans?
We have declared dividend here. This quarter also we have declared 7 rupees dividend. And we continue to follow the policy of 50 to 60% of PAT as a dividend payout as our capital allocation policy. And we will continue with that policy for the time being now.
All right, sir. Thank you very much for joining in. That is Sonata Software. As of now, there is, despite the noise that we are hearing in the external environment about uncertainty, it's not affected their demand pipeline. They're not seeing any negativity. They're confident about revenue momentum sustaining for the next 2 quarters. They sounded perhaps a bit cautious on the margin front because their guidance on margins is 20 to 22% for IT services business, which is a sharp drop-off from the current margin levels of nearly 26%. So we'll watch for how the margins pan out. There have been, there's lots to track in terms of numbers. The conference call takeaways from Maxfin were also up for you on your screen. So we'll try and get Yash to join us on the show to get us greater details on that. Those are the takeaways which you can see. We'll slip into a very short break on that note. We'll come back and address the currencies and commodities.
Hi, welcome back. You're watching Trading Hour. The rupee has hit a fresh low against the dollar this morning, and the bond yields have also surged. Lata is here, as always, with a complete analysis on how to understand this and what it means. Lata.
Yes, it was a fresh low in the morning of 83.20 that it would cost if you want to buy a dollar in rupees. Actually, it looks like the world is against EM currencies and Asian currencies. The way in which the dollar index has surged and US yields have surged. Usually when US yields surge, the dollar index also tends to strengthen because, you're getting a risk-free return in a 2-year US bond of about 4.57, 4.6. So, people tend to buy dollars so that they can buy treasuries. And as a result, in comparison, all Asian currencies, I mean, Indonesian rupiah is at a 2-year low, Taiwan is at some 6-year low, and yuan and yen is moving towards 150 for the dollar. The Chinese yuan is like some lowest since 2008. It was not unnatural that the rupee is continuing to feel the pressure. But there are actual buyers. Once it crossed that 82, 82.50, importers do panic. And today I hear that oil companies are very much there buying dollars. On Wednesday, we heard of a foreign bank buying dollars for some clients. And, these things are not one-offs. They could be even spread over several days. So we are going to see rupee under pressure. But it's nothing compared to what it was on Wednesday. It looks like a little more sedate now and a more gentle slope. The other thing that the market is guessing is that the Reserve Bank may be willing to use depreciation at least as much as it is using reserves, because reserves have fallen and our imports have risen. As a result of that, the import cover, you normally count reserves as 8 months of import cover, 9 months of import cover. A few months back, we were at 9 months import cover. Now we are at 8 months. And at 6 months, we would be where we were, during 2013, that fragile 5 time. So even RBI would be using depreciation as much or a little more than it was using in prior months. Once the market guesses this, then it can even take the currency a little lower. So all kinds of polemics are playing in the market at this point in time, all of them towards a declining rupee.
All right, Lata, thanks a lot for getting us all of the details on the move within the currency space, currently up, at 83.13 on the rupee. But with that, we're going to move on and talk about the commodity space as well. Manisha standing by to take us through all of the action that's playing out over there. Manisha.
Pavitra, thank you so much for that. Well, yes, commodity markets have continued to be quite volatile. And if you look at the crude oil prices, we are back around that $93, $94 per barrel mark. But even with that, we are looking at a weekly decline coming for the crude oil prices. Because remember, we have seen a high of nearly $95 in the previous week for the crude oil prices there. Good gains continuing onto that one. But the reason that you have seen the pressure come in because the markets are now factoring in another 75 basis point of a rate hike come the US Fed meeting in the month of November. As Lata was pointing out, the US Treasury yields also the highest since 2008 is something that's weighing on. And then the weak economic data, whether it has been about manufacturing numbers, factory activity, fixed investment numbers, real estate, home sales, all of that has been on the weaker side, and that's weighing onto the markets there. So crude oil prices off its 2-week highs, but we have seen 2-week lows rather, but we have seen prices continue to be under pressure. In other commodities and raw materials, you have rubber, which is trading at a 26-month lows. There is steel prices trading at a 23-month lows. There also is a World Steel Association report suggesting that in this year, you will see the global steel demand decline by 2.3%. It doesn't end there. When you look at the precious metal prices, that also has continued to decline. Silver is at a 5-week lows. Gold price is trading at a 3-week lows. Within the metal space, copper is continued to underperform with 3-week lows onto that one as well. So when you look at this week itself, the crude prices are down by 3.5%. Gas in US, UK and Europe has continued to decline, down by anywhere between -18 to -28% there. Rubber is down 4% this week. You have gold and silver down between 2 to 3.5%. In metal space, copper, steel, aluminum are down between 3 to 5% as well. And when it comes to the agri raw material prices, well, you have cotton prices down by 6% in this week. Coffee is down 7.5%. Even the tea price is down by 4.5%. So many of these agricultural commodities also have seen sharp decline this week.
Thank you very much, Manisha, for that complete picture. Slip into a break. When we return, we'll discuss market technicals. Himanshu Gupta of Globe Capital joins it.
Wishing all the viewers of CNBC-TV18 a very, very happy Diwali.
ये लो अब खाओ कद्दू इसके चक्कर में 2000 का चालान लग गया।
बाइक इंश्योरेंस रिन्यू करते तो नहीं लगता ना पापा।
इंश्योरेंस कितनी महंगी है पता है? मैं यहाँ पैसे बचाऊं, सस्ते कद्दू के चक्कर में 15 किलोमीटर दूर जाऊं।
2000 रुपए का सस्ता कद्दू।
बाइक इंश्योरेंस महंगी पड़ रही है। प्रीमियम स्टार्टिंग एट जस्ट ₹1.5 per day on phone pay. Tension free insurance.
Will snow days be a thing of the past? Or are we smarter than that?
We care for your best interest. Presenting the Canara Bank Special Deposit Scheme. Now offering 7.5% per annum for 666 days. Apply online or visit our nearest branch now. Canara Bank. Together we can.
Leading light. मतलब?
लीडिंग लाइट यानी जिसके परफॉर्मेंस में दम हो, जो हर रोल में फिट हो और हर घर में हिट हो, जैसे सिस्का एलईडी। सिस्का एलईडी, लाइट ईयर्स अहेड।
You guys all right?
या पर आपकी गाड़ी थोड़ी
कार एक्को से इंश्योर्ड है, सुपर फास्ट क्लेम सेटलमेंट हो जाता है। अरे मैं स्ट्रेस नहीं ले रहा हूँ, तू क्यों ले रहा है?
No more road rage.
So cool.
Acco, welcome change.
Indiabulls Housing Finance Limited announces a public issue of secured redeemable NCDs, offering coupon rate of up to 9.55% per annum and additional incentive of 0.25% per annum. Tranche 3 issue is open for subscription. To subscribe, log on to indiabullshomeloans.com. For risk factors and more details, refer to the Tranche 3 prospectus available on the websites of SEBI, Stock Exchange, Company and the lead managers.
Welcome back. You're still tuned into Trading Hour. For the markets, we're around 25 points in the red right now. So there has been a significant recovery from the lows. Like you can see, we'd marginally moved into the green as well. But right now, we're holding at around 17,490. So let's get a technical check going on the market. Himanshu Gupta of Globe Capital joins us now for exactly that. Himanshu, good morning and thanks a lot for joining us. We did get that gap down start. We moved up from those levels. Would you take a call on the index level today?
Hi, good morning to you. Well, I think yes, Nifty led by IT stocks is basically showing some signs of strength. And as a matter of fact, around 17,400, we have seen a decent amount of put writing as far as today's weekly expiry is concerned. So I think somewhere close to 17,440, 17,450, I'm comfortable initiating a long, keeping the stop loss below 17,370. And on the upside, I think there is a possibility that as we end closer to this weekly expiry, we might see a bounce towards 17,550, 17,580 in today's session itself. Nifty Bank relatively underperforming as far as the morning trade is concerned, but I think around 39,800, we can expect some kind of buying there. And on the upside, once 40,060, 40,100 level is taken, I think it will be the level when actually fresh short covering and fresh buying will be seen. So the view is positive, but given a choice, I'll be more comfortable initiating a long in Nifty at this point of time.
And what about stocks, Himanshu?
Yeah. So going with a couple of buy recommendations. The first one is a buy on TCS. Very strong set of derivatives data positioning here today. I think TCS is heading towards levels of 3,200, 3,220 in today's session. So TCS can be a long trade around current levels, keeping the stop loss below 13,125. Next two stocks on the cash segment, mid-cap space is looking good to me. First one is a buy on Mahindra CIE. Very strong set of chart pattern, and I think the stock is actually heading towards all-time highs. So Mahindra CIE is a buy around current levels, 321, 322, stop loss below 315. And on the upside, I think targets close to 350, 360 can be seen in today or in the next couple of days. So Mahindra CIE is again a buy. And finally, Bharat Dynamics. Defense stocks have been doing very good. And this stock has given a breakout in today's session. So BDL can be a long trade around current levels for a target price of 980 to 985, and a stop loss below 930 can be placed here also.
Thank you very much, Himanshu, for that. Let's talk a bit about KPIT Tech, because numbers were very strong in Q2. The company went ahead and upped its full-year guidance quite considerably on the revenue and on the margins. But the street was fairly unimpressed. In fact, on a week-to-date basis, KPIT is still down close to about 2% this week, despite very strong numbers. In fact, down close to about 3% in the last 4 days. So the view on KPIT Tech is mixed, despite the company reporting some very strong growth rates. So I've quickly done a bull and bear on KPIT Tech. The bullish argument is from Goldman Sachs, which post the numbers has raised the target price to 930. They say we like the company's clean exposure to strong ER&D spending, budgets on electrification and driverless car technologies at large global OEMs. Today, most cars have a greater element of software than hardware, and KPIT Tech is a pure play on that. And they see a clear path to a 30% EPS growth over the next 3 years. So which is why Goldman Sachs is a buy call on the stock. But on the flip side, Spark Capital has downgraded the stock to a sell, and their target price is significantly lower at 540. Reason? One, the recent outperformance, it's up 30%. It's outperformed the Nifty IT index by 30%, and valuations factor in the upside. KPIT Tech is trading at a 37 times forward multiple. It's trading at a 2.3x premium to its own valuation during the pre-COVID period when the valuations were about 16 times. Now it's trading at 37 times. It trades at a 50% to the IT sector average, and they're saying that if the auto sector globally gets impacted, then there is a risk to these premium valuations and they may come under pressure. So that's just, the two sides of the argument when it comes to KPIT Tech. Get into a break. On the other side, we'll discuss market fundamentals.
Hi, welcome back. You're watching Trading Hour. Let's get in a market opinion now. Nuvama Group, they have downgraded the financial sector while they've upgraded tech, telecom and internet. So let's, take a handle on what is the reasoning behind this. Prateek Parekh of Nuvama Group joins in to talk about all of this and, of course, the market fundamentals as well. Hi, Prateek. Thanks very much for joining in. It is said the first one through the wall gets a bloody nose. So are you prepared? Let's start with the call on the BFSI sector first.
Yeah. Hello. Good morning. Thanks for having me over. So yes, I guess we are one of the early ones to take the call on financials. So I'll just briefly tell about our view on markets. So today, if you look at the overall backdrop, it is a very challenging one, especially on the global front. Global PMI has moved into contraction, which is clearly indicates weak earnings or recessionary outlook. This is the fourth time where global PMI has gone into contraction. But what is very unique this time compared to what we have had in the past is that the rates are going higher. So from a global equity markets perspective, it is worst of both worlds, where you have earnings growth slowing down and rates going higher, squeezing valuations. This, as a result, is going to surely or is leading to volatility in Indian markets as well. And going ahead, we think that the global spillovers will actually broaden. Now, if you look at the global markets and the overall global economy, it has very large spillovers to Indian equities for sure. The spillovers come not just in terms of flows, but more importantly in terms of earnings as well. If you look at, for example, last 3 years, real GDP CAGR of India is just 2%. But Nifty earnings CAGR has been 20%. And a large part of this very strong earnings growth can be attributable to the global reflation, which flows to India in the form of prices, liquidity, as well as on the form of exports. When we look at the market internals, so far what markets have priced in is the whole prices pain point, where we have seen metal stocks and also the energy stocks cooling off and underperforming the headline indices. Markets to a reasonable extent have also priced in the concern on the export front, where IT has been one of the biggest underperforming sectors this year. Where we think that the next pricing is likely to happen is on the liquidity front. And this is the main reason for our downgrade of financials. Now, if one looks at financials over here, they have overall financial space has had a very good last 2-3 years. Last 2-3 years, despite the whole pain in the real economy, financials balance sheets have improved significantly. They have delivered the best earnings in a weak economy, and the large reason for that is the very strong liquidity environment. But what is changing now is that the liquidity surplus, which was at 8 trillion INR 6 months ago, has now largely vanished. And if you look at the rate transmission cycle in India, when RBI raises repo rates, the first segment where the rates get transmitted is actually on the lending front, which we have seen that happening, and across the board lending rates have gone up because a lot of loans are linked to repo rate directly. The next space where transmission happens is on the money markets. The short-end rates, CP/CD rates, there as well, the spreads have widened significantly. What we foresee going ahead is the transmission of rates from lending and money markets to now deposit rates. And here there's a lot of catch-up left to do. If you look at the weighted average deposit rate of the banking system, is roughly 100 to 150 basis points lower than what you get at a government GSEC yield. So to that extent, if rates remain tight for longer, I think incrementally from here on, transmission will be more on the deposit rates front rather than necessarily on the lending rates front. Question that we need to ask ourselves is that if deposit rates go higher, can banks again raise lending rates to maintain their higher margins, or will it lead to growth slowdown or other concerns? And here is where we differ from the street, and where we believe that while deposit rates will go higher, the ability to absorb rates on the lending front remains relatively muted. Households, the income outlook is not very great, especially with the fact that on the IT as well, the hiring, which has been the mainstay of hiring, is slowing down. MSME balance sheets are just getting repaired, and they're coming out of a big pain point that they had during COVID. And on the corporates front, while their balance sheets are very clean, they're very much delivered. But I think if global reflation goes away and prices tailwind is not there, their credit needs also will be lower, not only on the working capital front, but the around capex as well. Some of it can get potentially pushed out. And that's why we believe that on the financials front, where currently the scenario is very much blue sky, where margins are very good, you have no asset quality problems and credit growth is at a 9-year high. We do see some, hiccups coming up, which is in the form of, liquidity tightening, which will potentially peak out margins and also weigh on growth going ahead. Although I must say that we don't foresee any asset quality issues as of now.
Okay, so no asset quality issues, but do you see growth slipping for the banking sector compared to at least the consensus expectation? Can we talk a bit, Prateek, about the EPS expectations? Because currently the street is pricing in some solid EPS growth numbers for the next 2 years. Now, you've done some analysis. In the past crisis, in GFC, the EPS downgrades were about 25%. More recently, in the 2018 tightening, the EPS downgrades for the Indian economy or the Nifty was close to about 17%. But up until now, we've only seen about a 3% earnings downgrade. What's the extent of earnings downgrade? Do you see this picking up to double digits? And what would be the earnings forecast, according to you?
Yeah. So if you look at the whole consensus earnings forecast, right now the street is forecasting 15% CAGR from FY22 to FY24. We potentially see this as at risk, and our simple reason is that if global reflation is going to go away, then our earnings outlook will moderate. Nifty earnings, contrary to popular perception, are very strongly correlated with commodity prices. In fact, if commodity prices go higher, it actually helps improve the aggregate Nifty earnings, and also are very heavily correlated with global growth. And if that is going to moderate, I think the earnings downgrade momentum, which right now is very much concentrated in commodities, will potentially broaden out. And in our view, we think another 10% earnings cut can potentially happen over the next 3-4 quarters per se, is what I would say.
Prateek, out of time, but this has been a very insightful discussion. Thank you very much for joining in. That's Nuvama Group anticipating a 10% EPS downgrade from here on for the next 3 or 4 quarters. Get into a break. On the other side, we'll invite the management of Persistent System and get chatting about the company's performance in the current quarter and the outlook going ahead. Welcome back. As promised, let's talk about Persistent Systems. They've reported a very strong quarter, a 5.8% dollar revenue growth on a quarter-on-quarter basis, EBITDA margins coming in higher than street expectations, expanding by 30 basis points. We're now joined by Sandeep Kalra, the CEO and ED of the company on the show. Now, Sandeep, thank you very much for joining in. The worry in the street is that your company is facing some client-specific challenges. Can you talk about it? Is that true? And was growth affected this quarter on account of any client-specific challenges?
First of all, thank you for having me here. The growth for the quarter for us overall was pretty healthy at 5.8% in dollar terms. And if you look at the constant currency terms, it was even higher. Now, when it comes to client-specific, issues, there is a portfolio of clients that we deal with. If you look at our greater than 5 million customers, we have 30 customers greater than $5 million, and details are there in the fact sheet. So there will always be puts and takes. There will always be some customers which will grow faster. There may be some projects that finish. There may be some short-term optimizations that might happen. So we are not worried about the growth overall. This is the 6th quarter. If you look at the rupee growth, which is greater than 9% sequential. So from that perspective, absolutely not worried about the growth. And there will always be a portfolio. Sometimes services will grow, IP will grow. Sometimes one client will grow, sometimes the other client will grow. So no worries at all.
All right, no worries at all on that front. By the way, Canara Bank's numbers are flashing on your screen, and take a look at the stock because that is also moving up. So we do have a beat coming in on the profit front. On the NII front, it is looking like quite a good showing. The stock has just spiked up, net profit at around 2,500 crores. This is versus estimates that we had of around 1,950 crores. There's a good beat on that front. The NII has also come in above what was expected. It's at 7,434 crores. So there is a little bit of a beat there as well. This is versus the estimates of 7,300 crores. Provisions have come in at 3,637 crores. So the stock is looking quite good. We are going to get Abhishek in to fill us in with some details. But first, let's get back to the conversation that we're having with the Persistent Systems management. Mr. Kalra, can you take us through what you're expecting by the end of FY23 in terms of revenue and growth? In this quarter, you did hit a quarterly annualized run rate of around $1 billion. So can you take us through the growth expectations?
So for FY23, if you look at it for our last year, we were at $766 million. Our current run rate that we announced is 1022 billion or 1022 million, which is 1.022 billion. That itself is about 33% year-on-year growth rate. You can extrapolate. Even if we were to grow at a moderate pace from here, which may not be the case, we will grow at a fairly healthy clip. The least we will see is about 33% for the year.
Okay, hi Sandeep, morning. What would be the organic growth in FY23?
So a significant chunk of the growth is organic. Even at the current levels, roughly for the year, if you look at it, we are about 30+ % on organic terms. And now the rest few quarters, we do not expect any inorganic contribution. So it will be fairly healthy organic growth and among the industry leading growths from an organic perspective.
Strong commentary. They're expecting a 33% revenue growth for the full year, at least. And a chunk of that is going to be organic. Sandeep, can we talk a bit about margins? In the first half of the year, your EBIT margins were 14.5%. It's been steadily expanding. This quarter, you managed to expand margins after absorbing the wage hike impact. Can you build on these margins? What's the outlook for the next 2 quarters?
Right. So look, we have been, having an endeavor to make sure that we move up on the margins as we grow the revenues significantly. Now, for us, if you look at the quarter gone by, we've already done the pay hikes. So we have, absorbed the pay hike. The margins are after the pay hikes. The attrition for us is stabilizing, and for the industry as well is stabilizing. So that should also have a moderate to positive impact on the margins. We have inducted a lot of freshers. As they become, billable, as we, increase our utilization, all of those are levers to us in terms of, making sure that the margins are where they are. And hopefully, over a period of next few quarters, we take it up from there. So at the least, we are looking at, the last year margins, which were around 14% at an EBIT level, and improving from there for the full year.
All right, improving from the 14% level. Mr. Kalra, the BFSI revenue growth at around 3% is lower than what, the company's average is. What is the reason for this?
So if you look at the growth overall, there are quarters where BFSI growth has led the company growth, and there are quarters where technologies, companies, the ISVs that we deal with have led the quarter. So it's always going to be, some deal wins that happen, that ramp up and so on. Overall, some quarters from now, you should see maybe this being the leading segment among the 3. We have 3 segments, the ISVs, the tech companies, and the healthcare life sciences. So pretty much, we don't see any reason for this to, go down. So this will be, depending on deal wins and deals ramping up. And at times, there is deals that we win where we are helping optimize the spend, where we take on some on-site work to start with, and we transition over to offshore. So those are the puts and takes. So nothing to worry there, and pretty robust pipeline there as well.
Sandeep, FY23 is going to be a solid one for you, right? This quarter annualized dollar revenue has crossed $1 billion. Quarterly rupee revenues above 2,000, trailing 12-month EPS above 100. But now that you have set the bar so high, what can we expect in FY24, where the concern is a macro slowdown can moderate growth?
Right. So if you look at our, order book from a trailing 12-month perspective, the TCV is about $1.457 billion. And from a trailing 12-month perspective, the ACV is $1.087 million. So from that perspective, the overall order book that we have positions us fairly well for continued growth. And obviously, we have 2 more quarters to do the order book, perform, and so on. So we are relatively, confident. We have to be cautious. The macroeconomic environment is where it is. We don't control that. But with every adversity, we are seeing, good amount of possibilities for companies like us. We are fairly differentiated in the enterprise software market. We are fairly differentiated in the digital market. So that's what is, giving us the confidence of, having a fairly healthy growth as we go along. I wouldn't want to give forward-looking guidance, but if you look at the order book, fairly confident of continued performance.
Confident of continued performance. How would you assess the demand today versus, say, 6 months ago?
So the demand, if you look at it, the demand shaping has changed. The demand 6 months to a year back was more about revenue acceleration, was more about investing in the digital transformation activities. The demand today is partly that, and partly it is about cost optimization. Because if any of our customers, for example, a bank wants to be more digital in nature, they have to squeeze out, money, whether it is from their physical, bank branches or technology investments, which are bank, business as usual. So we are looking at the pipeline for companies like us being shaped around cost optimization much more than it was 6 months to 1 year back. So that is a new trend, and larger deals are in the offing on those lines, whether it is the independent software vendors we work with, whether it is banking, financial services, or healthcare life sciences kind of companies.
This seems to be the common narrative from all the IT companies, that the nature of demand has now changed. we're now seeing a greater percentage of cost optimization deals versus 6 months ago or a year ago, where a large percentage of the deals were about adding value, maximizing revenue, bringing in digital transformation. But now clients are getting conscious, they're being prudent, which is why now the IT deals are more geared towards optimization and bringing in more efficiencies. Sandeep, thank you very much for this conversation. Get into a break. As we do that, here is some great news for all our investors. You can track the US market action real time on Money Control. Log on to the Money Control website or app and stay informed. Let's talk about Canara Bank numbers. They're just out. Prima facie, it looks good, but let's get in Abhishek to understand the numbers in greater detail. Abhishek.
Well, it's a very, very strong quarter for Canara Bank after a long time. Just to start with, they have beaten on our poll, both in terms of NI and PAT. The PAT beat is almost 30% from where we were working. Asset quality, that has improved massively. Gross NPA ratio at 6.37% is perhaps at a 27-quarter low. The net NPA ratio of 2.19% is more than 29-quarter low. So asset quality is one of the best that you are seeing in last 7 years. Business momentum has picked up. The loan growth is pretty strong, coming in at 21.4% YOY and about 5.6% sequentially, which means that they have gained market share both YOY and quarter on quarter. Just to highlight, the net interest income growth is about 9.6% and the loan growth is about 5.6%, which means that they might have seen improvement in their net interest margin as well. To alert our viewers, the previous quarter net interest margin was at 2.78%. Operating efficiency, now that's the key highlight. It's at 22-quarter low in terms of cost to income ratio. So cost to income ratio is now down to 43.7% versus 44.8% in the previous quarter. The CD ratio has also improved, that is credit to deposit ratio. So all over, it's a strong beat across parameters for Canara Bank. Back to you.
Abhishek, thanks a lot for taking us through all of the highlights. It's really showing up in the stock as well, which will come up on your screen. That has seen a big up move, and right now it is up around 1.5%. Wow, it's spiked up even further. It's up over 2% in trade right now. That's Canara Bank on your screens. By the way, the global markets, while Hang Seng and Taiwan, few of those markets are still under pressure. The Dow futures, you can see, has reversed its losses. That one is seeing quite a recovery. It's up around 100 points in the green. So that's what's playing out across global markets. We're going to wind down on this edition of Trading Hour. Thanks a lot for tuning in. Halftime Report is up next.